Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're going to be talking about breakout trades and when breakouts fail, and then applying that to our best trade setups, or my best trade setups, my thesis regarding when trades fail, or when breakout trades fail, and how to identify a best trade candidate in the session that you are trading. Now, I talk a lot about Peter Brandt and learning a lot from Peter. Peter is a classical chartist. I've been trading for over 40 years. I've studied Peter's books. Schabacker, who Peter recommends as the original Bible of technical analysis for classical charting, and then, of course, Edwards and McGee. But one of the key things that I have learned from Peter is asymmetrical risk reward, which is where these geometrical patterns set up, rectangles, ascending, descending triangles, head and shoulders, those sorts of patterns, and how, when they complete for an entry, how a classical chartist would take these trades. And I've talked about Peter will use weekly, monthly charts, enter in on daily charts. He looks to see a minimum of 8 to 12, maybe 16 weeks, depending on the type of pattern and how those patterns will present. This is a weekly chart of the yen. And when these patterns complete for an entry, how Peter will enter and manage those trades. Now, one of the things that I've taken and applied for my own methodology, my own best trade setups, is applying the same classical charting mechanics to 15-minute hourly charts, but more the understanding that each day we are in a consolidation between a high and a low of a day, as well as a high and a low of a week. Because markets are fractal, we see these same patterns on our smaller time frames, and for trading a session can offer us, depending on the instrument, 50, 75, 100, maybe even 300 pips, depending on which instrument that is, whether it's an index, oil, gold, and in some cases currency. Some traders want to buy and hold or sell and hold for 3-4 days. My approach is to execute the trade in the session, lock in the money, get off the screen, and be flat at the end of the day. Now, coming back to just understanding classical charting, when these patterns complete for Peter to have an entry, we have our breakout bar. So a classical charting are breakout traders. Turtles were an example of that, but classical chartists will wait for the pattern to evolve and set up on the larger time frames, and then when the pattern completes for an entry, the breakout candle allow them to position themselves for an entry, risk management, and then also a profit target. Depending on the structure that they're trading, that can be one full expansion, maybe two full expansions, and as Peter has often mentioned, it's usually 3 or 4 trades that give him the bulk of his profits in a year. So understanding that a lot of small losses can be occurred when breakouts fail, the same understanding can apply trading intraday when breakouts fail. When a breakout fails on one side where other time frame traders have been triggered, hourly, daily, 4-hour, etc., on highs and lows of days and weeks, the logical place for them to head towards is the opposite side of that range, and often that will be where stop losses are placed on breakout traders. Now, if I was to come to the screen and look at any market heading into, I trade mainly the U.S. session, so an excellent question from a trader was, can you go over trades in the other sessions? And the same approach would apply regardless of the session that I'm trading. I've talked about the importance of the high and low of the day, because that's where, when those markets are broken, those levels are broken, whether it's a daily high or weekly low, daily low, we now will trigger other time frame traders into the markets, and that's when we can potentially see these larger moves take place as the structures evolve and set up. Now, just to provide an example of this. We'll go through a couple of examples on today's markets, but you can do this on your own charts. I want to go over the importance of understanding when a market breaks out, because traders are still struggling with some simple stuff. When the market breaks out, that is the breakout candle. So coming back to classical charting, if a market was to break out and a trader was to take that as a breakout trade in the long direction, we'll just mark this off. If they were to take this as a breakout trade in the long direction, they're long on the breakout candle. Their stop in most cases would be under the low of that breakout day. Now, Peter talks about different types of situations where he will use the second day rule, which is the second candle depending on the structure. Now, for all intents and purposes, what I'm trying to emphasize today is understanding when a breakout fails and understanding what a breakout is versus just a false break. We have a market that has closed outside of the daily high. This is a breakout candle. Tell me when this breakout has failed. When this market breaks down in the London session and closes below that breakout candle, this breakout has now failed. This market could break out, pull back, and continue long, but it hasn't. It's broken down, consolidated, and continues to break down. This breakout has now failed. So if we have traders on other time frames, though, daily, 4-hour, hourly, weekly maybe, who have entered the market long at the breakout of the high of the day, they may have stops at the low of the day. We have a market that has broken out on the 15-minute time frame and failed. It has failed and taken out the low of the session as well as the breakout candle itself, which leads us into our US window. If we have broken down on the inside after taking out the high of the day on a failed breakout, my thesis is low-hanging fruit for the trend continuation. Page 96. Now coming back to the understanding that there are only two types of trades: pump and dumps and dump and pumps. So there are traders who would have shorted the pump up, false break, failed breakout in the London session. And coming into our US window, we had major red news on the calendar for 10 a.m. But again, the thesis is pump and dump for the low-hanging fruit trend continuation. Which brings us to gold. And again, you can go through your own charts, hammering home the importance of understanding breakouts, failed breakouts, false breaks, and when markets fail. So we're looking at Thursday. We have a breakout that fails in our Asian session. So again, we have a market that breaks a daily low, continues to go lower. An example of a market that just breaks and sits there before going lower. But I would use that as my breakout candle. The market pulls back inside. When it closes above, this breakout has failed. Now, obviously, we could have tightened that up and down a bit lower, but using our breakout, the original breakout candle, heading prior to our new session, this breakout has now failed. If we go to our high of the day, we have a market that breaks out. Again, we'll highlight that. We have a market that breaks out of that high of the day. If I project that low across, this can give us a thesis heading into our new day, our new session, wherever that may show up. We have a market that then trades higher before auctioning sideways and trading higher in our US window up to the high of the day. Now notice it does not break out of the high of the day. That is not a breakout. We have pins, stop hunts, whatever people call them. We have not really triggered other time frame traders. We've triggered breakouts probably on smaller time frames. But we have higher highs on the inside after a failed breakout at the low of the day. the market auctions down in our US window in 3 pushes into our breakout candle. And again, we're on a 15-minute chart on a smaller time frame. Opportunities present for the trader to be going back long for the dump and pump trade back to the high of the day. Now, if we follow this across, again, we have a breakout candle now, a breakout candle. And if we project that across, we have a market that gave a high of the day, high of the session trade in our London window on Friday. The market breaks through the low of our breakout bar, stopping out our breakout traders. Okay, stops out the breakout trader who's gone long here. Again, we have traders obviously long underneath, but our breakout trader is stopped out. We have a lower low on the inside. Lower low on the inside is our formula for the pump and dump. We had the news candle and then the New York Open. The market auctioned down and took out the low. The New York Open pumped up into our failed breakout. You go to a smaller time frame, traders can see we had a breakout on the 5-minute chart after the news, a market that breaks out and closes outside of the range. So we have a failed breakout. But notice the breakout candle is a large, almost 100 pip candle. The market comes all the way back down to the low of that candle. This is prior to the New York Open. So we have a failed breakout. On the long side, we've triggered other time frame traders into the market. This market then proceeds to pump up into the failed breakout and engulfing at the New York Open. Lower low on the inside, failed breakout, lower low, pump and dump. So we have our engulfment candle. Okay, thesis is failed breakout at the high of day, high of week. We're going back down to the low of the day. The market breaks out of the low of the day. Now we have another breakout candle. We'll highlight the breakout candle. We're inside the low of the day. We haven't triggered the low of the day from the previous day, but we have our breakout candle. The market breaks out, pulls back, and continues down into our Monday. We have a new breakout candle on our Monday through the low of the day. This market breaks out and continues to go lower. We have other time frame traders in the market. The high of our breakout candle is still intact. This breakout is still intact. It puts a low in place before breaking down and going lower. We have a new breakout candle. A new breakout candle. Similar to what we just saw, the market goes sideways, out of range, out of balance in the gap time before making a higher high and pulling back inside. We have a breakout of a geometrical structure, a pattern within a pattern for the dump and pump. This breakout has now failed. If the breakout has failed in the downside, where might we be headed to on the upside? First target will be the high of the Asian session. And again, we have a breakout candle in our London window that is still intact. Breakout, continuation. Market breaks out again in our gap, just heading into our gap time. This is a 5-minute chart. We'll actually back this up to our 15-minute chart. See this a bit clearer. So we have our breakout candle. Just raise that a little bit down low. The breakout candle has now failed. The breakout candle in the long direction, however, is still intact. Breakout, new breakout candle at the high of the day. We have a 2-bar rule. So again, an example of where we have a 2-bar combination that forms the breakout. An example on a daily chart of where Peter would use the 2nd-day rule, which means the lower bar. Breakout, pullback, continuation. Heading into our US window now. Traders were looking for shorts and couldn't understand why I was looking for longs. We have a market that has a failed breakout. We've gone down. The market has failed in the breakout. We're back inside of the previous day's U.S. session from London, low of the day. Where is the money? The money, if this breakout has failed, is potentially up top. We have a market that broke out and failed. And on the upside, our breakout candles are still intact. So we have smaller time frame breakouts, but we've triggered other time frame traders into the market. And if this market is reversing and this breakout has failed, we now may be heading towards the high of the day, targeting where is the money. After we had our major red news, we have a breakout candle on our 5-minute chart. There was a first bounce opportunity. We'll talk about that in a second. But we have a breakout now of that, not only that high of day, but if we go back to our 50-minute chart, the high peak formation high of the most recent peak formation high of the previous day's U.S. session. So critical to understand, and this is after our major red news, we had a first bounce opportunity that continued back through the high of the day for 50 pips, targeting where is the money. We're in a market that's in reversal, and I'll just explain again the trade, the long trade after the New York Open. We have a box that's formed between 50 and double zeros, a geometrical structure. Some traders again felt this was a risky trade. This is the trend trade after the false break in the rectangle in a market that is heading back to the high of the day. This is the stop hunt down. There are traders who will short this out of the New York Open. I've taken these trades before. This was an all-in day, though. We're heading back up. This was the opportunity to get long. So one comment from a trader was he felt this was a high-risk trade. This is a one-bar stop. It's a W. It's a double bottom reversal. But prior to the news, when they go back the second time, because we're still going into major red news, we've taken out the high of the day. This is an opportunity now for traders to lock in the money. When they pull back and continue, any break of a low here is an automatic exit of the trade setup, because this is where they'll come back and get traders who are in the money prior to the news. If this market was strong and going to keep following through after the first bounce coming out of the low of the day before the news, it would continue to go higher. So as soon as they get to the high of the day, any reversal or consolidation or pullback is an automatic opportunity to exit the trade. Now, backing this chart up, to look at the chart, this is not a high-risk trade. You're not catching a falling knife. You're in an uptrend. This is the stop hunt down for the continuation back to the high of the day. Remember, who is caught in this market already? Who is caught in the market? Shorts are caught. They're caught here. They're caught here. They might even be caught trying to counter trend. They caught in counter trending in the U.S. session, trying to go lower. This market's going back to the high from the failed breakout, because that's where the money is. I want traders to memorize this pattern, because this pattern shows up a lot. It shows up a lot. There are opportunities sometimes where this move outside the stop hunt down can be 75 pips, depending on the size of the box and the type of template we have. But we can also see this type of move on oil a lot. And this is just a smaller time frame breakout that failed breakout candle, and the reversal continuation for the trend trade. Oil is an example of this. Just looking at West Texas, spot crude, they're the same. We'll look at West Texas. But today we had a $5 gap on the open heading into our new week. And as I tell traders repeatedly, wherever, it doesn't matter to me if the markets move 500 pips in one day. When the session opens, I am in a 100 pip box. Do you notice I'm in a 100 pip box? There's the high. The market drops down almost 75 pips from high to low, pretty much is 75 pips. This is the same trade. Breakout pullback to the high of the day. This is a specific setup that oil will do over and over. First hour down, second hour heading into the New York Open for the reversal trade back to the high of the day. This is Friday. Very similar, except the first hour went sideways after breaking out of the high of the day. So, okay, there's our same rectangle, but it broke higher highs in a trend trade before dumping down back through the low of the day. 1 hour down for the reversal trade back to the high of the day. The market had not finished putting the high of the day in place yet. Once it had the high in place, traders were shorting back down. Some traders were able to short and get something out of this, but the strong trade, the reversal trade back through the high of the day, was an opportunity to continue trading with the trend. This is Thursday. We have a market that has put a high of the day in place. We've broken the previous day's low. So again, a breakout that has failed. The market has gone higher and then put a high of day in place and then continued to go higher in that first hour. Higher highs without breaking out, and then a low before New York opens and breaks out. Again, you'll notice the same setup. Stop hunt down for the vertical move back through the high of the day. But coming back to the understanding that there was a failed breakout at the low of the day. So failed breakout at the low of the day, the stop hunt was down for the vertical trend trade back up. Friday, the difference was they had continued to go higher before auctioning down into the breakout pullback continuation. If we look at Wednesday's market, we have a market that put a high in place, a little bit higher in the first hour. No breakouts though, no breakouts. But then the market breaks out in the downward direction before reversing and then triggering the high of the day, lower low on the inside, New York Open, pump and dump for the move back down. High of the day, 3 pushes, a breakout that fails, and then a breakout that fails at the high of the day for the pump and dump, lower low on the inside, break in structure for the pump and dump at the high of the day. We can walk through any market. This is the British pound. I'll let you do this on your own, but reinforcing the importance of a breakout, a failed breakout, and a false break, and then the timing window of when these occur. And just in closing, we'll take a look at the pound yen. Again, a market that broke the low of Friday. Not a complete breakout, but it broke out enough to trigger breakouts. We don't have a lot of trap volume, so again, recognizing the difference between trap volume outside of a weekly higher low, daily higher low, versus triggering breakouts at the low of the day. Still have some volume trapped down low, but remember our breakout candle. Our breakout candle happens right at the beginning of the day. First bar breaks out. We have shorts triggered into the market. That breakout fails. That is not a breakout pullback. This market has failed. 1 push, 2 push, 3 pushes. They break the high of that candle and close outside of that range of that candle. This breakout has failed. Where is this market going? Heading into the new window, where could this market be wanting to go? Where is the money? Potentially at the high of the day. When we trigger the low of the day, we trigger all the other time frames into the market. If it's a weekly high, we can trigger weekly, longer time frame traders into the market, bigger players, monthly levels. But the daily level starts our thesis for the next best trade setup into our new window. We have a market that breaks out. Now let's mark off our breakout candle again. There is our breakout candle. If this breakout fails, heading into our new window, where is the first place they will target? Somebody's long on this candle. This breakout has gone out. The market pulls back, continues to go higher. This breakout has succeeded. It pulls back prior to our U.S. session window. Lower low on the inside. Lower low on the inside. I had a trader message me and put all these fancy names on this. I'm not going to sugarcoat anything. There's two types of trades: pump and dumps and dump and pumps. There's no fancy names. There's no all these other terms. You make it as complicated as you want, but as soon as you make it simple, your trading will improve. Pump and dump and pump. Lower low on the inside, back to the high of the day, pump and dump. We're at level 3. Okay, we're in the third level of rise. This market is ripe for our reversal trade at the high of the day, high of the session. Now we had major red news, but for all intensive purposes, we'll walk through the process. We have a market that pumps up and breaks down on the inside. New York open, pump up into our high of day, engulfment, pin, hammer for our short trade back down through the low of the day. Now there was not a lot of volatility on the major red news, but look at the two-sided auctioning. This is a dead giveaway. This market is going down. Our neckline, our death line is above 50. Look at all the trap volume above there. It is not all these other fancy names and terms. It is a pump and dump. That's all it is. They pump it up, they trap traders long, and then they dump it, pull the floor out, and there's your 50 pips. Some traders held on to this for 75. Congratulations. Excellent trade. There were several opportunities. But understanding the importance of the breakouts, that is key. Failed breakouts are where large moves begin. Hopefully you got value from that, traders. Thank you. Excellent questions. Again, appreciate your patience. Keep focused. I'll try to keep answering as many questions as I can. 1% better every single day. We are going to have tremendous opportunities this week. Sit back, be patient. Focus on your best trade setups. Have a great day, and may the markets go with you.